Hey there, everyone. Dave Keller here with Market Misbehavior. Today we're going to talk about 3 charts to follow to track leadership changes. We talk a lot about market leadership on my market recap show called Chart This with Dave Keller, live streamed every trading day at 5 p.m. Eastern, 2 p.m. Pacific. You can check it here on our YouTube channel, also on all the social media platforms. So give me a follow all around and you won't miss the next market recap. But we talk often about leadership, which is this answering the simple question, what's working out there? Today we're going to talk about 3 charts that I use every trading day to think about what's working, what's not, where previous leadership may be dissipating, where new emerging leadership is starting to improve. And I'll show you some of the tools that institutional investors use to make sure that they don't miss the next big thing from a technical perspective. Before we get to those 3 sets of charts and their implications about the markets here in September 2025, here's one more thing I wanted to tell you about. I spent many years earlier in my career working for large financial institutions. And when I left the institutional world, I remember thinking, what am I going to do to replace these big, expensive, but powerful institutional investing platforms that I've had access to this whole time? There is an option now for individual investors and financial advisors, and it's called Koifin. Koifin really combines some of those great capabilities of the big, expensive institutional platforms, along with some capabilities really optimized for financial advisors and high net worth individuals, and puts it in a very low cost, underpriced package on a web-based platform compared to the possibilities that you can achieve by using said platform. One of the features I love to use on Koifin are the ETF holdings. You can take an ETF, you can, like the QQQ, you can look at the biggest weightings, you can look at weightings by sector, you can run some basic attribution analysis. So for ETFs that you own or that you're considering owning, doing the due diligence of really understanding the exposures you're going to get is super important and super powerful for your portfolio. If you go to marketmisbehavior.com/Koifin, you can get 10% off any new membership. I hope you will check it out, and I hope you will find it as meaningful and powerful and impactful as I have found myself. Now let's get back to the charts. All right, so the first chart that I use to think about leadership is a classic chart that I learned about in my days at Fidelity. One of my predecessors in the Fidelity Technical Research Department, who ran the group in the 1970s, named Bill Doan, unfortunately passed away years ago, but I had a chance to meet with and talk with Bill a number of times, and we talked about just different ways of tracking market leadership. And he had shared an approach that they had used decades ago, unfortunately with indexes that are no longer were no longer reported, but sort of got me thinking about this general idea of offense versus defense. Right? You got to think about the equity space as a football game. We're now sort of getting into the meat of football season here in the U.S. So with American football, you have either the offense on the field or the defense on the field most of the time. When the offense is on the field, you have a much greater chance to score a touchdown, to get points on the board. You can score when the defense is on the field, but it's a lot less common and a lot less likely. So one of the basic questions that you ask, and Tom Dorsey, who's credited with really popularizing point and figure charting to a lot of investors here in North America, would often say, like, is the offense or the defense on the field? Let's start with that basic assessment. And this chart is the one that I use to draw that very simple conclusion. This is a ratio of the consumer discretionary versus the consumer staples sector. There's 2 versions, and the top half is a market cap weighted version, so the XLY and the XLP. The challenge with those particularly ETFs, particularly the XLY, super top heavy. So Amazon, Tesla, Home Depot make up about half of that ETF. And so you're really looking at those 3 stocks and then everything else. So in the bottom panel, we're using the equal weighted ETFs, or to be more specific, ETFs that track equal weighted indexes for the consumer discretionary sector and the consumer staples sector. And you can probably see here it's RSPD for consumer discretionary, RSPS. Those are equal weighted ETFs for those 2 sectors. The analysis on this chart is simple. If the line is going up, that means consumer discretionary is outperforming consumer staples. And if the line is going down, staples outperforming discretionary. Why is this so important? Well, if you've not heard me discuss it before, it is very simply, are investors favoring more things you want or things you need. When conditions are good, when consumers are confident, when they have plenty of money to spend, they tend to be willing to spend money on discretionary purchases, things you don't need but you want. New watches, new clothes, new stuff, new toys, new things you don't need, but they kind of make life a little more exciting if you have the money to spend on it. So when that line is going up, that means the expectation is that those types of companies are thriving because consumers are willing to spend that money. Those are more economically sensitive, right? Because it depends a lot about the economic conditions and the state of mind of the consumer and their spending abilities. But consumer staples are things like cleaning products, alcohol, tobacco, beverages, personal care products, toilet paper, right? I mean, that's the example I usually use. Like if conditions are good, it's not like you're going to splurge for the really good toilet paper. It's like you kind of just have that as a normal monthly or whatever expense, and you just kind of continue to have it around, right? So consumer staples are less economically sensitive because people tend to pay more consistently with those things that you need. You always need those. Your needs don't necessarily change. So this ratio is great at tracking whether investors are recognizing greater opportunity with those discretionary purchases that look like consumers are going to be spending money. And the ratio has been trending higher. But if you look at what's happened in the last 12 months, it tells you about these three kind of periods we've been going through. From August of 2024, which is a pretty decent pullback for the S&P 500 in terms of its nominal value. But if you look from early August to the end of January of 2025, this ratio was trending higher on both the cap-weighted and equal-weighted versions. People willing to spend money, or at least that was the expectation. Conditions are good. But look what happened in February of 2025. Both of these ratios start to break lower. Both of them break below their recent swing lows and go from a clear uptrend to a clear downtrend. This is when expectations about consumer optimism definitely change. And all of a sudden we're seeing more defensive rotation as investors are concerned about consumers' willingness to spend money on those discretionary purchases. The market bottomed out in April, early April, first week in April. You can see mid-April is when these two ratios bottomed out. And from mid-April to now mid-September, these ratios have generally been trending significantly higher. There's a bit of a hiccup there in June when the pace of the advance for the S&P slowed off a bit. But from there, the uptrend resumed. And so both of these ratios have been making new monthly highs every month since that June pullback. The equal-weighted version, which is less biased by those mega-cap consumer names like Amazon and Tesla, has already made a new all-time high in September of 2025. The cap-weighted version has not quite made a new all-time high, but is very, very close to doing so. You can see that here on the chart. So how bearish do you want to be when offense is clearly outperforming defense? That is the question I ask myself when I look at this chart. And even though September has often been, one of the weakest, if not the weakest month out of the 12 months, certainly in the last 5 years, in the last 20 years, in most look-back periods, September's been pretty rough. September's been just fine. And charts like this sort of help me recognize that there is still plenty of strength and plenty of optimism right now. So offense versus defense, one of the ways to just think about leadership in terms of are investors generally going more risk on or more risk off? As we can see right now, still risk on according to that analysis. The second set of charts, and this is really three separate charts I'm going to show you, are charts that I feature on my Market Misbehavior Live ChartList. This is a chart list that I keep on the Stock Charts platform, and you can access it at any point, by the way, going to marketmisbehavior.com/charts. And we have this chart list to sort of recognize the some of the key charts that I follow to assess market conditions in equities and some other asset classes as well. I have three sets of charts that group the 11 S&P sectors into three general buckets. Bucket number one, which we're going to look at here, are the defensive sectors. Bucket number two, the value or cyclical sectors. Bucket number three, the growth sectors. We're going to start with the defensive sectors because another way to think about that first chart, right, offense versus defense, is don't just look at consumer staples, but what about all the different ways that investors can get defensive? When we talk about investors getting defensive, what you want to think about is institutional investors, right? If you're a money manager and you run a $10 billion mutual fund, your mandate most likely says you have to be fully invested. And what that means is you have to own stock. So even if you think the market is going to go lower, even if you think the S&P and the NASDAQ are going to tank, you still have to be fully invested in equities. So what do? Well, you don't own high beta, high risk, growthy names that will do well in a bull market. You want to own defensive, lower volatility, higher dividend paying stocks that will most likely go down a lot less than the benchmark, right? Your goal as a money manager in a bear market phase, if you can't sell everything and just go to cash, you try to get defensive as possible so that your portfolio does not go down as much as the benchmark. So you outperform during that period. That's the secret sauce about how a lot of active managers at least try to outperform, is by outperforming in bear markets. It's a lot easier than trying to outperform in bull markets, which is actually quite challenging. So by watching these 4 defensive sectors from the top, we have utilities, healthcare, consumer staples, and real estate. We can understand if sort of institutional investors are rotating to more defensive positioning. Now, it's worth noting that the setup of these charts, we're not looking at the sector on its own. We're actually looking at the relative strength of the sector versus the S&P 500. So for each of these 4 data series, if the line is going up, that means the sector is outperforming the S&P during that particular period. If the line is going down, that means that sector is underperforming the S&P during that particular period. So what is happening to these 4 defensive sectors since the April market low? We can see that the relative strength on all of these has been generally trending lower. We can see specifically in the last 4 weeks, all 4 of these have seen a downside rotation in the relative strength. And the worst of these, consumer staples, as we alluded to in the previous chart, the weakest of all of them, making a new relative low, a new 12-month relative low just again this week. But all of them, from utilities to healthcare, from consumer staples to real estate, still generally underperforming. If and when these 4 lines start to rotate higher, that would imply that sort of thesis that I mentioned earlier. If institutions start getting more defensive, if money managers are concerned about the sustainability of the uptrend, they just want to hedge their bets and get more defensive, these relative strength lines should start to turn higher. I'm not seeing that right now in mid-September. So at some point, they'll most likely turn up. Keep watching my market recap show every trading day, and I'll definitely let you know if I see any change. But for now, we're not seeing it. So if those sectors aren't performing well on a relative basis, maybe the value sectors like industrials and financials are doing well. Not really, right? So if you look at the top panel, this is the industrial sector. Trending lower since mid-July. We can see financials, materials, energy. While they're not trending lower, right? They're not making new relative lows. They're certainly not outperforming. They're kind of more sideways, right? They're moving in line with the market. So we've actually seen some pretty decent charts in the financial sector, right? Stocks like Blackstone and some of the big banks like Goldman Sachs and Morgan Stanley are actually making new highs. Within the energy sector, within the materials sector, we're seeing things like gold stocks, right, doing quite well. Within the industrial sector, you're actually seeing like defense and aerospace names in some cases doing quite well. But having said that, most of these sectors, if not all of them, are not outperforming, right? We're not seeing any dominating outperformance from these particular names. So we're seeing sort of a market perform sort of in line with the benchmark reading for financials and materials. And also, to be honest, with energy, industrial is still very much underperforming. So these sectors are not performing very well on a relative basis. That brings us to the third bucket, the growth sectors. Now, one of the biggest changes that we've observed from the end of July to the beginning of September was the underperformance in technology. Off of the April market low, technology had been the strongest sector out of the 11, not even close, absolutely lights out outperforming. Note how since the April market low, communication services underperforming, consumer discretionary underperforming through the end of July. From the end of July to now mid-September, note how the communication services has done remarkably well. Stocks like Alphabet gapping higher and continuing upwards. The consumer discretionary sector really starting to perform quite well on a relative basis. Charts like Amazon improving, breaking out a little bit. Tesla certainly this week breaking to a new 3-month high. So we're seeing an improvement in some of the consumer discretionary names. We're seeing a dramatic improvement in the communication services sector. Even though technology has been underperforming, September so far has actually been a pretty strong month. So far in the last month, we're seeing the biggest outperformance from more growth, right? We've gone from technology as leadership to other growth sectors as leadership, particularly communication services and consumer discretionary. So these 3 charts really have helped me over the years to understand what's working and what's not. And when I think of that that question in sector terms, it's all about relative performance. What stocks or what sectors are showing a relative performance that's improving, meaning they're outperforming the S&P. And for now, it's a couple growth sectors that are clearly getting it done here in the last 5 to 6 weeks. Now, of course, we can put it all together. And back in the day when I was in the Ohio State University marching band, go Bucks, we would have a demonstration that we would do at concerts where each instrument would play. And then at the end, the commentator, the announcer would say, put them all together, and they sound like this. This is what I think about when I look at the relative rotation graph, the RRG. Julius de Kempener is a fantastic technical analyst and market strategist who designed this visualization a number of years ago. I've known Julius and followed his work and worked with him for many years, and have always appreciated the benefits of sort of looking at the entire market conditions in terms of sector leadership in one visualization. So this one visualization actually combines all those other charts that we've talked about. It allows us to compare 2 different sectors. So here I can see the XLY. I can also see the XLP. So if offense over defense is working, then consumer discretionary should be rotating northeast and consumer staples should be rotating southwest. That's exactly what we've been observing here over the last couple months. And by the way, you can put this entire visualization into motion to see how things are evolving over time. It also combines what we looked at with these 3 charts looking at relative performance, because we can see the technology sector, which has been the strongest for quite some time, but note how it's actually heading a little southwest. So the XLK is actually lightening up a little bit. What's improving? Look at these 2 sectors right here, consumer discretionary, communication services. So the RRG basically is a scatter plot that allows us to analyze relative strength and how that's evolving over time. To be honest with you, I've not found any one of these approaches on their own to be enough. I like thinking about offense versus defense specifically and making that basic, almost daily assessment. What's working, offense or defense, consumer discretionary or consumer staples? I love looking at the relative strength lines of each of these 11 sectors grouped by their category, because I found that helps me really understand rotation from growth to value, from value to defense, and on and back again. However, I also love the ability to look at all of those things in one visualization and do a very quick assessment on different time frames. By the way, I'm looking at weekly. I often look at the daily RRG as well to see which sectors are showing strength, which sectors are showing weakness, and which sectors are starting to change, what we call a change of character. For now, it seems to be rotating from growth leadership to other growth leadership. But by continuing to follow these charts going forward, you should be able to detect the next rotation of leadership all by yourself. How did you find this analysis of leadership? Are there any charts or tools that you use to assess leadership trends that I didn't mention? Make sure you drop a comment below and let me know. I'd love to hear about it. That's it for today. For Market Misbehavior, I'm Dave Keller. Have a fantastic weekend. And remember, it's always a good time to own good charts.